Welcome, everyone, and thank you for joining Treasury Strategies' 8th Annual State of the Profession Message. I'm Kathy Gregg, a partner here at Treasury Strategies, and I'm joined by Tony Carfang, also a partner at Treasury Strategies. And as we do every January, we've assembled our thoughts about where Treasury is headed for 2014 and thought about how we can help our clients be most successful this year. A quick aside, everyone who's registered for this session in a day or two will receive a copy of the presentation and a link to the recording. And should you wish to ask questions, you can do so in the question box in the bottom right-hand corner of your screen, and we'll handle these questions offline when the message is done. Let's start with a quick review of the past couple of years. In 2010, when we had our State of the Profession message, we were talking about our impression that central government regulatory response to the financial crisis was going to be massive, intrusive, and global. And it was. In 2011, we were talking about the elephant in the room, which was prolonged low interest rates and inflationary potential, and the thought that the central banks would not be out of the liquidity business very soon. Well, that certainly has proven to be correct. In 2012, we were looking at recovery fatigue. We had this cute diagram of tired little kids in the back seat of a long car trip, because that's how we were feeling. Are we there yet? When is this recovery going to be over? We felt like we were still dealing with the aftermath. In 2013, last year, however, we could see that we had turned the corner. It was the 5th year after the financial catastrophe, and while we weren't declaring victory or suggesting we have a parade, we felt that recovery was well enough along its way that Treasury needed to be moving on and looking to the future. Humble folks that we are, our main conclusion from this review is we were right. So let's move on to 2014. What's uniquely important for Treasury for 2014? Well, we see here that it is time once again to begin charting our own course. We've had many years after the crisis of being reactive, however you want to call it, battening down the hatches, waiting for the next shoe to drop, biding our time till recovery. But now it's time to reoccupy the helm and proactively set our own course in Treasury. And we have 3 main ideas for doing this, which we're going to discuss today. First is maintaining relevance. Secondly, what to do about the regulatory impact hitting home. And third, how we're likely to be affected when quantitative easing actually ends, which could begin as early as this week in the United States at least. Now, as we go through this today, I want to caution you, you may get the impression that there are a lot of problems ahead for Treasury, but that is absolutely not the case. On the contrary, this is the perfect kind of environment that's going to showcase Treasury's importance in the firm and their financial analytic abilities. So with that as a setup, Tony, why don't you start us off?
Thank you, Kathy. Well, first, let's remember the Treasury has always played 2 complementary roles inside of a corporation, a strategic role and an operational role. The strategic role has been one of optimizing the balance sheet, financially positioning the company appropriately, getting the right capital structure, getting the right access to credit. The operational role has been one of efficient execution of the day-to-day transactions and the short-term cash management, the forecasting, the receivables, and the payables. Well, unfortunately, the financial crisis altered all of that, and we are now in year number 5 of the hangover. The poor polar bear must be here in Chicago with us today. It's that cold outside. The crisis changed things, and over the past 5 years, corporate Treasury has been responding to market events, in some cases having to be defensive, in other cases reactive, clearly nimble and clearly performing important functions, but more of these had to do with getting through the uncertainties, the hangover from the financial crisis. The strategic role was one of, we need strategies to survive, we need access to capital, we need strategies for managing risk. The operational roles have been around daily liquidity, the cost of making a mistake was very low. But now, as we approach 2014, the hangover is over, and it's now time to take control of our own destiny. And one of the first things we need to do is get back our former relevance, the non-survival mode kind of relevance. During the financial crisis, many of the things that we did defensively, while they were appropriate, they allowed some of our other skills in Treasury to atrophy a bit, and we need to come back and make sure we sharpen those skills. Investment management, we're moving from objectives of return of capital to now return on capital in 2014, 15, and beyond. We may not be at the top of our game, and we need to be at the top of our game when the investment markets and the interest rate markets change. Similarly, the cost of a bad forecast was zero, because if you forecast incorrectly, instead of investing at zero, you get to invest at zero. So, that was the fallout of the hangover, but that's behind us, and now Treasury needs to take control of the destiny, as Kathy mentioned, chart its own course, and move to Treasury 3.0. Prior to 2008, many companies were preparing to make Treasury the financial nerve center of the firm. In a 2.0 environment, companies optimized and implemented best practices within a number of silos within the Treasury function. 3.0 integrates that. Many companies began taking the first couple of steps down that road, but then the financial crisis came, and those things were on hold. Well, now it's time to resurrect that. Moving proactively into Treasury 3.0 means integrating both technologically and financially with the entire rest of the firm. Treasury is in a position to become the nerve center. Serious analytics on top of the trove of information that flows through the Treasurer's office is key. Strategic treasuries will be able to do what-if analysis, balance sheet stimulation, stress tests. What happens if quantitative easing unwinds one way versus another? What happens if you have inflation, et cetera, et cetera? We need to put in place the analytics to test all this and then to proactively move forward. And we also need to take advantage of Treasury's central hub position in the corporation and integrate with all of the lines of business. And over the past 5 years, particularly with the advent of enterprise technologies and enterprise technologies moving into the Treasurer's office, there are now more opportunities to do that than ever. In fact, next week, our technology practice is putting on our regular quarterly Treasury technology briefing, and we'll be doing a deep dive into a number of these issues. So you take the right-hand fork to the road, become strategic, resurrect the strategic, get rid of the hangover, go down the path of Treasury 3.0. The risk is fading into the background. The operational aspects of Treasury could become paramount in the organization if you're not proactive strategically, and Treasury and all of its functions, not just the operational functions, but all of its functions, become relegated to shared service centers, get outsourced, become victims of cost reductions or staff reductions, and Treasury just kind of drifts down into an operating function. So our conclusion, Kathy, is be proactive and chart your destiny, take that path on the right, and in 2014, resurrect all those plans you had back in 2008 to make Treasury the financial nerve center of the firm.
Okay. All right. So now we're going to move on to subject 2, which is thinking about the regulatory impact finally hitting home. Are you tired yet of hearing about regulatory impact predictions? Well, hang on, because the vortex is about to touch down. The crisis did indeed have its massive, intrusive, and global regulatory aftermath. And at this stage of the game, the new regulatory restrictions and regulations and principles are fairly well established. and the actual rulemaking is nearly complete. Enough so that we see banks starting to lay out their responses, planning for exiting some services, changing their portfolios, thinking about new products, things like that. And we see that changes are about to be felt by commercial customers. Globally, we have Basel III well underway. And Basel III is, from a Treasury standpoint, primarily going to impact bank capital and deposits and liquidity. In the U.S., the Volcker rule has been set down. In December, it was finalized as the final act of Dodd-Frank. Primarily, we'll focus on reining in banks' roles as intermediaries in several markets. We think it's pretty interesting that outside of the U.S., where oftentimes we think the regulators never met a regulation they didn't like, they did not follow the U.S.'s lead on the Volcker rule. So we've got Volcker going active in the U.S., but nothing like it in the rest of the world, which is going to set up some interesting region-to-region differences that may prove important for Treasury. And then globally, money market fund regulations are still being sorted out, but there's obvious potential impact on corporate short-term debt and investment markets of what they're talking about for those. So here today, we have four lenses through which we want to consider the regulator impact for Treasury. First, capital markets. Second, deposits and liquidity. Third, risk management. And finally, cross-jurisdictional businesses. So let's first talk about the capital markets lens. What we're going to see here is more restrictive trading and market making by banks in some arenas that's going to diminish the efficiency of those markets, giving them wider spreads and increased costs. And at the margin, some alternatives may disappear. There will definitely be an impact on bank lending. Bank capital is going to be much more focused on and will be more restricted, which means that lending capacity is going to shrink. And the question will be, politely stated, which firms are no longer in the bank's focus? Or more plainly stated, who is it that's not going to get the credit? We're also going to see impact on certain debt and investment markets if the money fund regulations go through. Some of these proposed changes would make money market funds far less useful as corporate investment tools, which will have the result of shrinking the funds, which will in turn shrink the market for some kinds of corporate and municipal debt, raising the prices for that kind of debt, making it far more difficult to place. Okay, turning now to the deposit and liquidity lens. The new focus of banks here is how deposits behave. So what do I mean by that? The question is, during a crisis, what kind of deposits can be counted on to stay or stick at the bank, and which are likely to flee? And making sure there are adequate assets to cover the runoff. Remember, the focus of this part of re-regulation is never again will there be a bank bailout. Well, we'll see if that happens, but nonetheless, the regs are here. And they are ushering in a new era of corporate deposits. From the bank point of view, sticky deposits are good, and non-sticky deposits count against my ratios, and they're more costly to have on my books. Many of today's commercial DDA deposits, which is the typical corporate deposit, will be defined as non-sticky, the not good kind. And we expect to see a raft of new products arise with terms and conditions that will transform those conventional DDA deposits into deposits that can qualify as sticky deposits. So we may see products that add things like a notice to withdraw, or perhaps a 30-day revolving term, something completely different than what we've been familiar with. And some banks may be reluctant under some circumstances to accept deposits at all. In fact, a couple of our clients told us that at the end of the year, they had trouble placing deposits with large UK banks. So I think it's going to be a completely different world. This is going to totally turn our deposit world upside down. Deposits aren't necessarily good. Large deposits may not give me leverage as a big customer. I may have to pay a bank to leave my deposits. This is going to be like Alice in Wonderland, falling herself down the rabbit hole, something we have not seen before. Now turning to the risk management lens. Regulatory objectives in risk management have gone beyond managing risk and trying to push through all the way to eliminating risk. But we know that properly assessed and priced risk is essential and fundamental to the way our markets operate. That notwithstanding, the outcomes of the risk management regs for corporates are going to be fewer, more expensive, and less customized tools for risk management. Risk management trades are going to be pushed onto the exchanges. And you may find you're not able to hedge as well as you had been previously. Your hedging efficiency may decline, and in some cases, they may be so inefficient or not cost effective that you end up making a new decision to go unhedged, whereas before you would not have. And then the final lens we want to discuss is cross-jurisdictional challenges. In these regulatory monitoring structures, banks are required to manage their metrics at each jurisdictional level. The quaint definition is every institution with legal personality. They are not to aggregate their measurements across entities or currencies. The regulators want these things siloed. And the possible impacts back to Treasury are on products that help us manage our cross-jurisdictional exposures. Notional pooling in particular is something likely to be affected, and there may be other effects of this. At the very least, tools like that are going to be more costly and more complex, possibly less useful, maybe not available at all. And as I already mentioned, the regulations are not going to be consistent across regions, which will create competitive advantages and disadvantages that don't exist today that treasurers need to consider. Options no longer viable in one region may be available in another. So if you step back and think about the impact of these regulations cumulatively, it implies several things for Treasury. First of all, we need to stay very close to our most important banks. You don't want to be surprised when a bank won't step up where it did before, or when an important tool is no longer viable. We could need to revisit our capital structure or balance sheet strategy, the global deposit or liquidity structure, the overall risk management process and program, and possibly the structure of the overall banking network. The thing for Treasury is you want to be able to call some of these things before they actually happen. That's got to be part of our strategy for maintaining relevance. Okay, Tony, topic 3, when QE goes away.
Thank you, Kathy. I know you're modest, so let me just point out, when it comes to regulation, the role that Treasury Strategies has played here, and that 2 weeks ago you actually led a breakfast meeting of members of the United States Congress discussing financial reform. It's a fascinating discussion that we'd be happy to share with those of you on the line. Last week, Dave Robertson actually testified at the House Financial Services Committee regarding some of the consequences of the Volcker Rule. And just yesterday, we delivered a report to the members of the European Parliament, Freudian slip there, regarding money market fund regulation, and we'd be happy to share that with you. Just drop us a note. When quantitative easing unwinds, what the heck's going to happen? Well, over the last several years, central banks from around the world have pumped trillions, you name the currency, they pumped trillions of it into the economy, greatly increasing the amount of global liquidity, and I mean, literally trillions upon trillions will have the effect of distorting the markets. The markets that we see today are markets that are artificially papered over with huge excesses of global liquidity. Now, at Treasury Strategies, we're not necessarily saying that was unnecessary. simply stating that that is the case. Although as a parenthetical, let me say that in the U.S., the Fed is pumping in $80 billion a month or $1 trillion a year in order to increase GDP by $500 billion a year. I'll let you do the math on that one. What this has resulted in, though, is low to zero interest rates around the world. These central banks' excess liquidity is being pumped actually around the world, relatively seamlessly. We have a relatively flat yield curve. We have a lot of liquidity. As Kathy pointed out, banks no longer find many deposits attractive, and we have investment yields of zero. All of this because of the phenomenal amount of stimulus and liquidity that the central banks have pumped in. So what happens when this goes away? Warren Buffett famously said that when the tide goes out, you find out who's been swimming naked. Well, there are a lot of problems likely, a lot of risk below the surface that we're only going to see as the water recedes, as the liquidity begins to tighten. As corporate treasurers, you need to anticipate what might be lurking below the surface and understand how that's going to impact your company, how that's going to impact your cash flow, how that's going to impact your counterparty risk, how that's going to impact your access to capital, how that ought to cause you to want to restructure your balance sheet. A particularly interesting challenge here is that these waters are likely to recede at different paces in different regions around the globe. We've already seen the central banks easing at different paces. The European Central Bank, for example, has eased, tightened, eased again, and it's been a start and stop. Japan was very slow in easing, and now has a put on an accelerator that would be the envy of anybody who drives a Lamborghini. So that will create additional dislocations because we won't have a uniform receding of the floodwaters. Well, we advise our clients really 4 things here with respect to preparing for the unwind of quantitative easing. Number one, stay focused on the strategic and make sure you have in place the robust analytics to stress test your income statement and your balance sheet for any what-if scenarios as the waters recede. We don't know what's below the surface, but there will be problems along your supply chain. There will be problems with the counterparty risk. Some of your financial institutions will have problems. That's a certainty. We just don't know what the specifics will be. Number 2, become very aggressive in your risk management and your risk monitoring. The risks are there. You need to have a keen eye out across the waters to see as soon as any unforeseen risks emerge. Number 3, keep your board informed. Nobody likes surprises, and there are going to be surprises here. So it's your job to let the board understand that when quantitative easing ends, there will be a lot of unforeseen, unpredictable events here, and that you have your eye out for that. And then finally, put in place your contingency plans. Get in place now action plans for the possibility of the waters receding and there be an outbreak of inflation. Or in some parts of the world, you may actually have the waters not receding and an experience of deflation. What will you do if you're doing business in each of those areas? What will you do if you're obtaining finances in each of those areas? Have that plan in place now so that in the heat of the battle, you have a plan to dust off. You're not flying by the seat of your pants. Action plans for rising rates. What will happen to your income statement and balance sheet when rates begin to rise? What will happen to your business when the yield curve steepens? How will that play? How should you play that? And then finally, action plans for regional dislocations. And there will absolutely be regional dislocations. While regulators and our elected leaders talk about harmonization, The fact of the matter is local politics will always trump, local economic needs will always trump, and there will be dislocations. So in terms of 2014, let me just review. Go back to the strategic, do your analytics and stress testing. Make sure your risk management is as sharp as it can be. Keep your board and keep your CEO and CFO in the loop, and have your contingency plans in place. That is our advice for 2014.
So what we see lining up for 2014 are a number of things that can turn out really well for Treasury. Since it's 9 below in Chicago today, I'm going to use this analogy. Our hometown football team, the Chicago Bears, are completely geared to play football in the snow and cold. When it's on TV and you're watching it, it looks incredibly rugged and crazy to everybody else. But it's what we call bear football. And similarly, the 2014 environment is going to showcase Treasury's ability to be in command of the vessel. And at this stage, the maps are good enough that we can see enough of what we need to navigate to make those actions. So, just to recap, in terms of maintaining your relevance, we want to get back to the 3.0 plans and activities that got put on hold when the crisis first hit, and avoid that little detour in getting relegated to a cost-reducing shared service center. That's quite a fate I don't want to consider. Secondly, in terms of regulatory impact coming home to roost, you need to stay close to your banks and your providers to see how your company is going to be affected by these things, how your deposits are going to be affected, how your lending might be effective, the products that you use for global liquidity and deposit management, your risk management, how all of those things are going to be affected, and plan accordingly. And finally, what happens when QE starts going away? My summation of what Tony said is some serious analytics and action plans, the kind that, again, like the Chicago Bears, other people might find gnarly and rugged, but in Treasury, this is what we do, and we do it well. So, when this call is over, what we'd like to suggest you do is take a couple of minutes and write down the 1 or 2 best ideas you had while you were listening. And think about how those things can help make 2014 your best year yet. And then over the next week or two, we'd like to hear from each of you about your ideas for 2014. And at that time, we'll be happy to share even more of our thinking about that. So please, give us a call. Thanks again for joining us today. We hope that you have the best Treasury year ever. And Tony and I look forward to talking with you.